This conference will now be recorded.
Okay, there are there are four financial statements: income statement, statement of retained earnings, balance sheet, and then there's the cash flow statement. And this is the statement that you've got to look at when fraudulent activities are involved. Overall, the company is just not doing well. The cash flow statement has three sections: operating activities, investment activities, and financing activities. It's got three types of activities. When you graduate, hopefully you're going to have a job that will pay you some money so that you can buy some new assets, pay off student loans, and have money left over. So that's what you get personally, what you want to do. When we have a business and we start a business off with 100,000 in cash, we get our common stock back. Our goal is to have this cash go up through earnings, revenues minus expenses, and dividends. That's always the goal in a business. So you always are looking at that. So the statement of cash flow is going to provide information about the liquidity. Like companies going bankrupt, it's going to help us with that. We can look at changes in assets and liabilities, stockholders' equity. We can compare the cash flow statement with those of other companies. We can look at the timing of revenues, and we can try to see if fraudulent activities are involved. Once again, there are three types of activities on the statement: operating, investing, and financing. As an individual, it will be great if you have a salary when you graduate that pays you $100,000. So it will be just dandy if you had $100,000 when you graduate as your salary. You were able then to buy some new assets, new car, new house, make a down payment. Minus. Let's get this in. Then, pay off some student loans and still have money left over. So if you bought some assets and paid off student loans, how much money would you have left? Like you got about what? About $45,000. So you'd be in a good situation. Well, when we look at companies, it's the same thing. Operating activities equate to your salary. Investing activities equate to you buying assets, a car, and a house. When we look at a company, we want it to be expanded. We want this number to be negative. Financially, we want it paying off debt, hopefully, and having cash left over. So, operations, are the sales, all the current activities of the company. Investments are where you buy physical assets to expand. Then financing is how you finance. Do you borrow, whatever? So, and we're just looking at this, globally. We'll get back to it. When we have these four sections on a cash flow statement, A model cash flow has operations, sourcing and use of funds with a net change of $1 million. Investments 400,000. We want to see that because you got to expand. We want you to pay off uh, debts and have money left over. That's the model of how a cash flow statement should look. So, number one, you got to look at the cash flow statement for a company. And number two, you got to see if it meets, these criteria. Operations, positive. Investments, negative, because you're expanding. This could be positive, possible, but you want them paying off this, and you still want cash left over. That's what you got to be able to determine in a company. So let's go and let's look at our fraudulent company that we were looking at last time. Let's look at our fraudulent company that we were looking at last time and the 4 journal entries that they made. And I asked you to do what? Prepare me a cash flow statement. So cash, common stock. For those 4 parts of the cash flow statement, where does journal entry 1 go? It should go in part 3. Where does journal entry 2? X. We're not going to use it when we do our cash flow statement. Journal entry 3 here, that goes in part 3. And journal entry 4 goes in part 1. Now, when we did our trial balance, we said that the company had sales of 10 million, operating expenses of 4 million, net income 6 million. We looked at the balance sheet, had some cash 2 million, had receivables of 10, so total assets were 12 million, and total liabilities and equity were 12 million. And if you stop right there and you didn't look at a statement of cash flow, then a lot of you said you go on and invest. But now you need to look at a statement of cash flow, and you need to look at that statement of cash flow based on the fact that we want operations to be positive, investments to be negative, financing to be negative, and the change in cash to be positive. That's what we want to see. So let's go ahead and do that statement of cash flow. Going back to that first journal entry where we paid the cash, that's going to be in part 3. So when we go to statement of cash flow, for the common stock, we're going to put $1 million down here. So if a cash flow statement was done, it'd be $1 million here. When they borrowed the 5 million in the second journal entry, that's going to be down here also. So we got a total of 6 million that came from this direction. Now, journal entry 3, because it didn't involve cash, it does not come on the statement of cash flow. Then the salary expense, that's an operating item, so that's going to be in part 1 as a negative. So when we go back to that statement of cash flow, the salary is going to be in here as a use of cash. And therefore, since it's on the use side, part 1 has a minus 4,000, or 4 million. So when we look at this company, part 1 has a minus 4 million, part 3 has a positive 6, and we get to the cash that they have, But based on our criteria, are we going to invest in this company now? So, Audrey, this is where, for the investment you all are making, the person puts the money in, and these are other investors like you all, and they take that money and they pay themselves. So this is so they don't have any income, so this is negative. Uh, and then when they, when we look at it and we come back, then they go to that year two, get your money and declare bankruptcy. So that's what companies do. So we get the year two. So if you looked at this statement based on that criteria, you would have known not to give them your $1,000,000. But if you didn't know that and you give them your million, they pay themselves some more money and they go into bankruptcy. So the Ponzi schemes and all of these things work that way. They pay themselves the money. They don't have income really. Then they declare bankruptcy and you might get 10 cents on the dollar. So okay, they go into bankruptcy, they go into bankruptcy, you're not getting all your money back. And so as a result, you've got to look at the statement of cash flow. You cannot just look at an income statement. You must look at the statement of cash flow. Are there any questions? Are there any questions?
I have a question.
Yes.
Why'd you subtract the 4 million? I thought you usually subtract the one from part two.
No, it's actually, remember, it's three parts. There's operations, that's a source. Then there's the use, and then what's left. So we subtracted because you used it. You had $100,000. You spent 40,000 to buy things. That's minus. You don't have the cash anymore. You spent 20,000 to pay student loan. That's a minus. You got 40,000 left over. So we're showing the source of the money and what you did with it and what you got left over.
Okay.
The,
So I just want to clarify. You said subtract. You always subtract whatever you used, right?
yeah, and we're
Okay.
gonna look at the cash flow. We're gonna look at it. We did it simple as principles one, uh, but in essence, that's what's happening. Uh, if cash comes in as a source, if you pay it out as a use, and what's the difference? And so when you don't look at this, uh, then you get misled into thinking that the company's doing okay, but it does not have any operation. So remember, all those companies were uh, inflating the revenue. Well, the way they inflated the revenue, the way they inflate the revenue is by making this journal entry. That's how they inflate the revenue. And they do other things, but the bottom line, this is not going to be collected. And the bottom line is this: if you got a financial statement showing income, but there's no cash on the balance sheet, you got 6 million in income, you should have had 6 million in cash. You could have other assets, but when there's a big difference between the income and the cash, there is a problem. So, what you all are going to do, this is an individual project due about a week from now. All of you are going to select the company that you want to work for. Or you want to invest $1,000,000 in it, because when you work for a company, that's $1,000,000. It's got to be a publicly traded company. And I want you to look at the financial statements for 3 years, the cash flow statements, and tell me whether you would invest $1,000,000 or not. So this is not a major project. It's not a right or wrong answer, but you're going to look at you're going to have one page, a slide talking about the company, what it does. You'll have another page where you go and uh, make a copy of the cash flow statements, and then you're going to have a third one where you say whether you would invest $1 million or not. So let's just see. We can.
I have a question, Dr. Boyd.
Yes.
So the remaining, what, 2 or 3 groups that didn't present their fraudulent companies, are we not doing that?
We're doing it later today. We'll do it in, it really, see, when you present now, I want you to present with this knowledge of the statement of cash flow. Got it? So we'll be to that in a few minutes. Let's see, we can look at the Macy's annual report. So are you all going to invest $1 million in Macy's? See if we can get these annual reports anywhere. I know you can't see this. I'm just trying to see if I can see if it's in here anywhere. Consolidate it. Okay, so here is Macy's cash flow statement. And let's just see if I can. So can you kind of see this now? Okay. So let's look at Macy's. In 2018, they had $1 billion in income, and in 2019, 564, and then in 2020, they lost $3 million. Okay, so you see that. So the cash from operations, 17, 16, they did have 650,000 in cash from operations. In investing activities, they still invested 325. And then in financing activities, what does the 699 represent? That means they borrowed 699,000. And so net decrease. So the cash went up, but most of it came up by borrowing. So that's what I want you to do. So you're talking about the company, then you look at their cash flow statements, and you make a determination of whether you would invest $1 million or not. That's what you should do with any company that you're going to work for or any company that you're going to invest in. You have to look at the income statement, you got to look at the balance sheet, and you got to look at the cash flow statement. I don't want any uh, Apple, Microsoft, uh, companies like that because their stock is already high, and so as a result, uh,
When is the project due?
about in a week's time. So it's not a major thing. It's just like that cash flow statement. So it's
Okay.
not a major thing. Any questions? So just to get you to look at a cash flow statement.
And you said it has to be like a small company?
No, it has to be a large company that's publicly traded, so it has a cash flow statement.
And to find the cash flow statement, we just Google it?
Yep, Google cash flow statement for the company that you're looking at.
Okay.
And that's the last 3 years.
Yeah, last 3 years, whatever the last 3 years. This is just to get you to look at the statement. See, most times people don't look at the cash flow statement. So that's just kind of a fun assignment, just like the one, it'll be like the one on the bankruptcies. And you begin to learn something, that, is appropriate and can help you. Now, before we move to the other fraudulent company report, so as you're presenting now, you're thinking about this framework of the report. If we have 1,000 journal entries or 10,000 journal entries, we cannot uh, it's hard to do a cash flow statement and go in journal entry by journal entry. So we got another way that we're going to do it. A fundamental equation in accounting is asset equal liabilities plus stockholders' equity or owner's equity. Is everybody familiar with that statement, that journal entry? Excuse me, that statement, that equation? That's the basis for all accounting. It's the basis for you. You got assets, you got liabilities. The difference is your equity. If your assets exceed your liabilities, you got a positive equity. If your assets are less, then you got a negative equity. So then we say asset equal liabilities plus common stock plus retained earnings. Then we say cash plus the other assets equal liabilities, common stock, retained earnings. We're just still working with that equation. Then we define everything in terms of cash. Cash equals current liabilities, long-term liabilities, minus long-term assets. And this is in the primer. Then cash equals current liabilities plus long-term liabilities plus common stock plus net income minus dividend minus current assets minus long-term assets plus contra account. So we just gone from this equation and put three cash plus other assets. Then we define everything in terms of cash. And then you can go down here and determine the change in cash by just looking at the changes in all the other accounts. And so that's how we're going to do the cash flow statements. We're not going to look at 10,000 journal entries. We're just going to look at the accounts. And I got a template in here that we'll go over next time with an example of how we do it. But we're going to come at the same thing, but it's not going to be journal entries. It's going to be net income and changes in accounts. So just look at that and we'll go over that next time. Okay, so let's see if we can get back to these fraudulent company reports. Okay, so who's up today?
Group 1 for sure.
And what's your company? Who
Company
submitted?
is Z Best Cleaning Service.
And who submitted?
Sierra Branch.
Sierra Branch. Let's see if we can download it. Let's see. Okay, so ZZ Best Cleaning Company. Excuse me for just a second. I've got to go to the door.
Yeah, hear me?
Yeah, we can hear
Okay,
you.
okay. So coming back to ZZ Best Cleaning Company. What's our company information about ZZ Best?
I'm gonna open it on my end because it's really, really, really hard to read on your screen.
Okay, go ahead and now you can always your screen. Let me see if I can. That better?
No. Oh
Okay.
no. I'm gonna just open it on my end.
Anybody else see it?
I can see it and I can go
I
ahead and
can
read
see
it
it.
if that's okay.
But one
Yeah,
of the
that's
things
fine. I just was gonna open it on my side
on a
so I
PowerPoint,
can see.
you don't want a lot of detail down and you want it readable. But go ahead.
Okay, well, Z's Best is a carpet cleaning company founded by Barry Minkow at 16 years old. Um, the company went public in December 1986 and was valued over 300 million. The business performed poorly as Minkow was dealing with customer complaints, and he began to create the illusion of a profitable company, and to do that, he used the Ponzi scheme, and which netted millions of dollars. And he kept the business afloat by engaging in several fraudulent acts, such as credit card fraud, staging burglaries for insurance fraud to fund operations, the investors and investments, and the suppliers.
Okay.
And this side is basically the same thing. Basically, what he did as the business
I can
as a
I can actually
business.
speak on this slide too, cause I did some stuff on this slide. So he kind of ran like a Ponzi scheme, and he kind of based this scheme on fake checks and fake insurance claims, and doing stuff to basically say he should receive this money, and then getting it, and eventually, as you will see once we keep going on, like he got caught.
He went bankrupt
I'm
and you
sorry.
tell me with assets for $64,000. Okay, that's what was left. So how much was the fraud amount?
over millions. But I forgot to, I didn't want to interject, but on that company slide, a piece of it, I guess, got cut off, that the company was founded in Inglewood, California,
Okay.
just to put a location into things.
Okay.
It got, my whole slide has been edited, but it was founded in Inglewood, for sure.
Okay. Give it a go over. Went over some of nine line. Okay, so it's in Inglewood. So what do we do to him? This nice looking young guy. What do we do to him? Y'all put him in jail for 25 years?
Well, eventually, everything that he was doing with the scheme and embezzling money and money laundering, it caught up to him and to the business because what a Ponzi scheme is, and he was um, getting investors, but he was paying the older investors back with the new investors' money. So the investors eventually noticed something was wrong, and then that all caught up to him.
Hmm. So why did he get 25 years? I was just asking.
He got 25 years for like racketeering and basically money laundering, security fraud, different stuff like that. Cause it never really stopped. And even when he kind of got caught, he kept doing it.
But we didn't get a peep at Wells Fargo 25 years.
So
I
the
think
way
his
we thought that he was, oh, go ahead.
Go ahead. I was just wondering why he got 25. Why were you all so hard on him?
yeah, the money laundering, just money laundering, literally.
So you see here, he
Well,
took loans from dubious figures and shoveled money between bank accounts,
and he also
specifically
put it up.
enough for banks to lend him enough money. See, so that's the thing. He got the cash through banks. So what does that tell you? If you had looked at his cash flow statement, what would you have discovered?
Um, the banks.
If you had looked at his
What was
cash,
the question?
if you had looked at his cash flow statements, what would you have discovered? That is, what kind of cash flow
The
statement
real,
he has. If you can
You will
imagine.
notice.
that
He
the
had a
money
lot of
didn't
money
exist.
coming in to invest in the business. There'll be a lot of common stock, in my opinion, coming
A lot of
in.
stock. Then you have these long-term loans from the banks.
Mhm.
That's